DOGE, Elon Musk's organization reporting to President Trump, wants to audit the Fed, and the Fed doesn't want them to audit the Fed. So, what's the Fed hiding? Today, we're going to talk with Bob Coleman, a precious metals expert who does a lot of serious study about the Federal Reserve and monetary policy, fiscal policy, about what is going on at the Fed and why might they want to not be audited? What are they really hiding something? What's actually going on here? So, Bob, welcome to the Wealth to Build show.
Sure. Thank you, Tom, for having me.
So if you could, Bob, give us just a little bit about your background, because I know you've done a lot of research into everything from the standpoint of precious metals, monetary, fiscal policy.
Yeah, I have an extensive background. I started actually in the investment business back in 1992, back when it was Dean Witter. And so it's back in the Quotron days, I guess you could say. So have kind of grown up in the sort of the financially regulated markets, stocks, bonds, that type of thing. And then 2001, I started my own registered investment advisory firm. I started my own hedge fund at that time. And then in 2006, 7, I saw the whole thing melting up, and I was like, this is not going to end well. So I ended up setting up a depository company because I wanted to hold precious metals outside the system. And so that was actually set up in 2008. And then 2009, I started working with wholesalers buying and selling metals, and then working also with refineries and so forth. So we deal with high net worth, ultra high net worth investors. We deal with retail investors. We deal with people all over the world to buy and sell metals with. And then we also store it here at our depository, which we store about $800 million roughly of metals. So we're a fairly large player in this business. And then we also deal with logistics and insurance of moving metals. So it's really anything that has to do with gold and silver, and then also watching the financial markets that I'm running a hedge fund with that's also invested in physical metals. I try to be a student of everything as much as I can. So it tends to allow me to provide a little bit more insight with how the industry is working, how the markets interrelate with the precious metals, what kind of policies are going to affect the stock market or the metals in general or commodities, that type of thing.
So let's start with some basics here for our listeners. And let's talk about what the Fed is and what it isn't. And then let's get into monetary versus fiscal policy. So how do you describe the Fed's role when it comes to the U.S. government and the
Yeah,
economy?
you could look at the Federal Reserve basically as the U.S. government's bank in a way. So they a lot of the swap lines and a lot of the sort of the plumbing of the financial system is really run through the Fed, supported by the Fed's policy and trading actions, their trading desk in New York and so forth. So there's a huge overlap of when it comes to treasury issuance and so forth, the funding of the primary dealer system, buying those U.S. treasuries at auction and so forth. There's a lot of unity there, I guess you could say. And so when it comes to policy action, when you look at fiscal and monetary policy, fiscal policy is really directed by the government, by Congress and so forth, and executive, on the executive side of the administration, U.S. Treasury, that type of thing. The fiscal
Well,
policy is actually directed by the Federal Reserve, and that
the
tends.
monetary policy.
I'm sorry, yeah, right, monetary policy,
Right. So,
yes,
to be clear, fiscal policy is how much money the government spends and how much money they take in, right?
correct.
That's pretty much it. And how does that differ from monetary policy and what the Fed does?
The Fed tends to get with money supply, interest rates, on the short term, influence the influence that they have with in terms of liquidity in the system. You got to remember the U.S. Treasury is really in charge of the dollar, whether the dollar wants to go up or down. That's more of a fiscal policy initiative, whereas the the Federal Reserve is really dealing, like you said, more on the monetary, the banking side of the world.
So the Fed actually, they're the ones who print, excuse me, the Fed's the one who actually prints the money, right? It's not the US Treasury that increases the money supply and decreases the money supply. They just tell the Fed, basically, we're going to spend this money. We need to borrow in US Treasuries, and it's the Fed basically that floats the Treasuries. Is that fair?
Yeah, what actually happens on the technical side is that when the U.S. Treasury comes to market with debt that they need to raise capital with in order, like you said, spend money, they'll go through the primary dealers, which the primary dealers are like the banks and the broker dealers that buy that have the obligation of buying that debt from the U.S. Treasury, and then from there those primary dealers sell that debt into the open markets. During quantitative easing in 2020 and 21, the Federal Reserve was actually buying 90% of that issuance. So in that type of instance, that was just pure money printing. The Federal Reserve expanding the balance sheet at will to take in all this debt, where that debt doesn't actually create a drain on supply of money. So that allowed the stock markets to rise, and it allowed inflation to kind of start to run rampant because there wasn't any sponge to soak up that debt.
Got it. So the Fed likes to pretend that they are independent from the federal government. Why is that, and how independent are they from the federal government?
Yeah, I think there's you could say a Chinese wall would be a good example. That they're not supposed to be politicized, but it's very easy, especially after Reagan's administration and going into the 90s with Clinton's administration and so forth. You started to see this blend of monetary fiscal policy, dollar direction, the strong dollar scenario where they tried to promote certain policies to benefit the United States. At the same time, they wanted to promote this idea that the dollar was strong while spending a lot of money. So, which kind of they kind of negate each other. But it's that type of blend that has sort of kind of brought the Federal Reserve, and the U.S. government as sort of one. And there's a lot of talk out there that the Federal Reserve, the trading desk and a lot of the employees and so forth are more liberal leaning in terms of their maybe their policy directives and that type of thing. And so depending on which president or which administration's in office, there could be a rub there in terms of, hey, this is the new policy direction, and we expect the Federal Reserve to potentially support that. So a great example of this would be, there's a lot of talk out there with gold and revaluing gold on the Treasury's balance sheet, because right now it's held at $42 an ounce on the Treasury's balance sheet. Well, if the U.S. Treasury wanted to revalue that gold higher, that's a directive from the Treasury. It doesn't really need the Fed's authorization to do that. But if they wanted to revalue the gold higher and then all of a sudden spend that money, then the Federal Reserve would be part of that entire picture. Because what happens is at the Federal Reserve, there's something called the TGA, or the Treasury General Account, which basically is the U.S. government's checking account. That's where they spend the money. And so they need that interaction in order to, if they revalue the gold, that would actually allow the balance sheet to expand, and then they could collateralize that gold, or go out and spend it, whatever they wanted to do. But then they need the Fed to actually process those transactions.
Oh, okay. So the Fed processes the transaction. So why does the Fed then seem to resist interaction? Because they seem to resist interaction with the federal government. And it's like they say, the Fed said, well, our job is to control inflation and make sure that the unemployment doesn't get too high, right? They seem to have stated those are there too, and yet the federal government goes off and spends, and it's actually the federal government that seems to me that causes the inflation. Then all of a sudden the Fed's supposed to rein that in, which is what we've seen. But it seemed like under Reagan and Volcker seemed to very much walk in step on this, and they seem to coordinate their actions, which is presumably how they brought in stagflation to its knees, basically in the first term of Reagan's presidency. What's happened since then, and why is it the Fed doesn't want to be audited, and why is it they say they don't want interference from the administration?
Yeah, the auditing of the Fed, I believe the only portion of the Federal Reserve that isn't audited is actually the trading operations in New York. Other than that, I believe everything else is auditable by the Inspector General's office. Yeah, but that again, where the money is, and really where the Fed makes all of the their profits from is really New York's operations. Other than that, the Federal Reserve obviously is a private entity. It's given quasi sort of powers. But the idea behind it is to try not to blend politics with monetary policy, because at that point, it would investor confidence would start to break down, because at some point you'd start to feel like, okay, now the Fed is just being dictated to, and if the Fed wants a certain administration in power, they will be very loose with policy, for example, and be very supportive of trying to pump the asset markets. What's actually happened this last 4 years under the Democrats was Janet Yellen, being the Treasury Secretary, actually what she was doing was counter to the Fed's actions. The Fed was actually drawing down their balance sheet, but what Yellen did was actually she actually brought down the duration of Treasury debt. Typically they issue a lot of 10-year notes and 30-year bonds and that type of thing. Well, 74% or so of their issuance the last few years was 1 year or less paper, T-bills, for example. And so what happened was the banks will lend against those T-bills more so than they would lend against a 10-year note, because every time interest rates move, the longer the duration, the more sensitive that longer term debt is. So what happened was the last few years, as the market started to ramp since 2022, was that hedge funds and banks and insurance companies and pension funds were basically buying T-bills that the government was just shelling out because they were spending so much money. And then those players would then take the T-bills that they bought, take them to the bank or the broker dealer and say, listen, I want to borrow against these T-bills. And they were allowed to borrow, 90 cents on the dollar and put those funds into the stock market or other asset markets. And that started this big levitation in the markets that was actually against the Fed's wishes of drawing down the balance sheet, not buying any more treasuries, for example. So they kind of countered each other. So sometimes one influences the other, or has maybe more influence.
Well, Janet Yellen, having been a previous Fed chair, certainly would know how to manipulate the Fed, and clearly did, it sounds like, in that situation. So what doesn't the Fed want DOGE to see? Why don't they want to be audited? Why don't they want this audit?
From the Federal Reserve standpoint, yeah, I haven't really read too much on the Federal Reserve. More focus has been on, Fort Knox. Do they have the
Right.
gold? And then obviously with a lot of other interdepartment agencies, the Federal Reserve, it's really it's really overseen by Congress. The idea probably would be, hey, listen, is all the money that is, that basically is being spent by the Federal Reserve, is it really, because you have to remember the Federal Reserve in their charter, basically their excess profits have to be sent back to the Treasury. And if you've been people that have been watching the Federal Reserve closely, they've been losing money actually because of interest rates rising, and their Treasury
Yeah.
the treasuries on their balance sheet have been going down in value. So there's a little bit of maybe some I guess from a standpoint of trying to not cook the book, so to speak, but actually just try to say, listen, we need to keep some of this stuff maybe not as disclosed to the public because it's maybe sensitive information. But yeah, more of the headlines lately has been more on uh, the Treasury's position of their assets, and gold especially.
Okay, so two questions. First of all, going back to your comment that the Federal Reserve is a private entity, so it's chartered by Congress. It has rules set up by Congress. It's private entity, so who owns it?
The banks. I mean, I think going back, and I've done studies or looked at this stuff, and going back to the 1920s, and even Lehman Brothers was a member that actually went under, which was kind of hard to believe. But yeah, it's basically the big banks that are the chartered members.
So it's a bit of a cartel.
Yes. Yeah, the Federal Reserve is designed to support the banking system. And that's where the frustration from the public comes in because, the 2008 bailout and, of course, the 2020 bailout, where the Fed just simply increases their balance sheet by $3 trillion. What it does is it doesn't put a rein on speculation and malfeasance. It only encourages it that much more. And then, of course, then that encourages more fiscal spending that
Right.
turns into deficit spending.
Right. So let's talk about Fort Knox. Is the gold there in your opinion?
Yeah, I mean, it's interesting that Ron Paul did it's sort of a testimony or hearing in 2011 about the Fort Knox gold and so forth. But what he didn't realize was actually in 2005 to 2008, 699,000 bars were actually weighed, counted, and uh, reviewed against the current bar list. And then also the Department of Army actually went in and assayed a lot of bars as well. So there was actually testing that was going on. There was full counts that were going on. And then at the same time, the Inspector General's office every single year will do an audit on the schedules and seals of the gold as well. So you typically you don't need, as long as nobody goes in the room or the seal is intact on the door, there's no need to go in and recount every single bar every single year. And that's what the Inspector General does each year is they make sure that internal controls are in place that says, listen, we know that nobody has gone in here. And so you kind of have to take the government at its word, but the Inspector General's office tends to have enforcement powers, and it's a department of government that has teeth.
All right, so let's switch gears a little bit, talking about gold and what's going on in the economy right now. Traditionally, you expect gold as an inflation hedge, which would mean that as the dollar goes down, gold goes up. But what we've seen in the last few months is the dollar going up and gold going up. What's happening there?
Yeah, it's something that I kind of start talking about on I have an account on X or Twitter, and I post a lot of information on a daily basis. And what I noticed after the election with Trump, President Trump, was that he started introducing, he started talking about tariffs, but obviously when he now became the president elect, those tariffs became uh, more of a certainty, I guess you could say. And so early December, I wrote about this idea that if tariffs started to be more of a concern uh, in the marketplace, well, you have to go back and look at prior instances when tariffs were implemented with Trump back in 2000 in his first term. And so if you go back to 2018 when he introduced tariffs on China, those tariffs actually carried through on refined gold and refined silver coming from China. And most people weren't aware of that. So now what you have to look at is the way the industry works, the financial system works, is that you have a lot of gold. The physical gold market is traditionally done more in London, and so they call that the spot market. And in New York, that's really where the futures markets are, and the futures markets are a hedging market. So what you tend to have is people buying or owning the physical market in London, and they use the New York market to sell against, or create a price neutral type of environment. So there's what they call the spread, and the spread is called an exchange for physical spread. And so what happened was, when you're short metal in New York and your metal's over in London, all of a sudden, if there's a tariff that comes into the picture and that metal happens to be in London, happens to be a Canadian bar or a Mexican bar like Panolis, or Australian bar or Chinese bar, and now you have to bring that metal to New York to cover your short position. All of a sudden, if it's a 25% tariff, it's going to cost you 25% more of the value of that item as a cost to bring it into the country. So if you had $1 million of gold, for example, and that was attributable to a tariff, to bring that into the country, that would cost you $250,000. That would sink a lot of players immediately. That's an enormous cost that cannot be that can't be reproduced or offset.
So you don't think the rise in gold as a result of tariffs is tariffs in general, but actually tariffs on gold?
Yes. Yeah, you're basically, it's an interesting concept because you're putting tariffs or taxes on money and making that money more expensive. And so what happened was, from December into February, the largest buyers of gold and silver were the banks, because the banks typically had very high short positions against spot contracts, spot deferred contracts, or their own physical inventory. And of course, then you have to look at, also, banks deal a lot with derivatives. So they issue a lot of derivative products to investors and institutions and so forth, that says, listen, if you want representation of gold, we'll write a contract for you, and so you can follow along that price and have representation of price movement, but we'll back it with our balance sheet. Very similar to, if you watch the movie The Big Short, where Michael Burry went to Goldman Sachs and said, can you write me a contract on shorting the mortgage market? And they all laughed at him. Well, it's a very similar type of thing. They created a derivative product. And so if you look at the Office of Controller of Currency, currently there's hundreds of billions of dollars of derivatives written against precious metals. And so a lot of this stuff was to say to the banks, wow, we have some major exposure here. We actually have to go out and buy this metal in case our counterparty wants actual delivery, and and obviously we can't take the hit of if a tariff comes into play, the day after inauguration, that type of thing. So that started this sort of cascade, and so the spread
Basically, they're
started.
planning for the tariffs.
Yes, yeah, and the spreads blew out, and the banks stopped selling metal into the markets, and they were just going out and buying as much as they could. And so you had this huge demand for large physical bars, unlike the retail investor, which was actually selling the market. They were actually disenchanted and not really believing the rally. And so you had a lot of small product that was available for inventory, but the large bars were really tight. It's kind of an odd type of an event that happened, but that basically is what inspired this big price move. And now you're having things kind of settle down right now. The spread trades have settled down. Leasing rates, for example, which had spiked about a month ago, they've settled back down. This need to get physical metal has kind of slowed, because there's been just 600 tons of gold coming into the COMEX over the last 3 months.
Got it. So what do you see as the future in the next year or two when it comes to both the dollar and gold?
Yeah, gold is going to be. You have to remember, the central banks have been net buyers of gold, really for the last 15 years, and they've been picking up that pace. They tend to actually, when prices go up, they tend to buy less. But what we've been seeing is they've been continually buying, and part of that is the idea that, hey, when Russia invaded Ukraine and we just basically confiscated, Russian treasury, or Russian wholly owned U.S. treasuries, a lot of banks or central banks said, well, listen, if we don't want to be on the U.S.'s bad side, and we certainly don't want to have our assets confiscated, we may want to own a neutral reserve asset like gold. So, and then they also looked at their own balance sheet. They looked at their own country's economy, and they said, listen, we're going to have to inflate out of our mess just as much maybe the U.S. is going to have to inflate out of their debt mess. So they're using gold as sort of a anchor to their balance sheet. And gold's an interesting asset because it's been around 5,000 years. It's this idea that it has no counterparty risk, but it's something that has stood the test of time. And I think that's the admiration that the gold market has, and why governments are so sort of anti-gold, because it is a competitor to their currency.
Interesting. So, what do you see happening with the dollar? The dollar has been getting stronger. Presumably, that is the threat of tariffs because tariffs do tend to make the dollar stronger, which actually makes the goods we export more expensive to the people we export them to, but actually makes the imports less expensive. So, actually, a strong dollar would help to offset the cost of tariffs to the American public. How do you see that moving in the next little while?
I think President Trump probably wants a weaker dollar, and they want lower rates. So when President Trump says we need to get interest rates lower, he's wanting a weaker dollar, and that would of course help U.S. exports overseas, and that would counter potentially any tariff that another country puts on our products. But if I'm right, and the idea is basically the only way out of this mess is to try to create inflation and use cheaper dollars to pay off our debts, which is what typically every fiat country usually does since the beginning of history. Um, I think the idea is that the dollar sags lower or drives lower with interest rates with maybe the Federal Reserve or the U.S. Treasury trying to guide rates lower as well. Yeah, because the tough thing that the administration has going for it right now is just the massive fiscal spending that's been going on the last few years, and cutting that fiscal spending is going to have an impact on the economy. And
Right.
if the economy slows down, that would tend to tell you, hey, listen, maybe rates will pull back. But it's odd because you're right, tariffs could actually stoke inflation. So you could actually have a situation where you have stagflation, where the economy slows and inflation picks up. And
Yeah,
I think that's a benefit for gold.
I think it depends a little bit on what you call inflation. I mean, in a general sense, people think an increase in prices is inflation, but in the truer sense, or at least the technical sense, inflation is the increase in price as a result of supply and demand, not a result of taxes. So we don't think that, for example, if your city increases its sales tax, that's caused inflation. When no economist would say that's inflationary, they would say, hey, it causes a rise in prices, but it doesn't cause it. It's not that direct impact on supply and demand, which we typically think about with inflation. So I find that I just, that concept of are tariffs inflationary, they are in the broader sense that it increases prices, but not in the technical sense that it's not really changing supply and demand quite as much. There is obviously some pressure there. So, what do you think will happen with in the end? So, if the dollar is going down, which is what you say President Trump wants, then that would certainly continue to put upward pressure on the price of gold. Is that fair?
Yeah, that's what I would think would ultimately happen. It's kind of an odd environment that we're in, because the retail environment, up until maybe a week or two ago, when you started to see a lot of the hype in the markets about Fort Knox and that type of thing, it's odd what gets the retail environment excited about gold. But uh, we're basically seeing the setup that I see happening is that the retail investor has been disengaged with the market. They've been selling all the way up. They haven't been believing the rally. And you have institutions that are saying, listen, on the other hand, I got to own gold because I'm looking at this idea that we're going to create these 50 or 100-year bonds, for example, that we're going to try and convert or extend out our debt duration and force these countries that take 100-year bonds that are normally holding 5-year paper. There's this disenchantment that's forming around the world with buying U.S. Treasury debt, and like Treasury Secretary Bessent was saying, his job is he's the top salesman to sell Treasury debt to the rest of the world. So you got to make that debt look as appealable as possible. And the tough thing is you also got to service that debt. And I think liquidity is still going to be something that continues to be pumped into the market. Um, uh, they have no choice. I mean, it is truly an inflate or die type of policy that we've seen, which is not different from many other fiat,
Right.
empires throughout time.
So do you see then? So gold's around 3,000 right now. Um, do you see it breaking 3,000, going up towards 4,000, 5,000? Is that what you're seeing because of that inflationary policy?
Yeah, I think there's a long because I look at the long term. When you're dealing with the metals markets, I'm more of a physical investor. I really promote the idea of owning physical versus these derivatives and paper contracts because a lot of people will try to trade short term, and this market is extremely volatile. But from a longer term standpoint, until we can actually get the budget under control, fiscal order in balance, and so forth. Um, there's still going to be a lot of questions out there, and there's going to be a lot of shenanigans of trying to keep this whole game going. And that's what I kind of see right now. Nothing's really come about. It's nice to see the DOGE sort of going after the excess of spending and some of the what fraud or malfeasance that you see with a lot of these departments and so forth, especially with these so-called charitable organizations. But I think that's just headlines. He's not really cutting into the real meat and potatoes of the deficits, which is really the interest costs on the U.S. debt,
Yeah.
entitlement, Social Security, Medicaid, that type of thing. Those are a much Department of Defense spending, that type of thing. Those have a huge impact on the fiscal deficit picture, and I don't know if they're going to cut that. And that's a worry that ultimately they can only do so much. And I think that's the concern in the gold market is it's great to have that type of change, but at the same time, there are realities to this picture.
So you just mentioned that we'll finish with this, that you like physical gold. Why? I mean, the obvious benefit of the paper representation is it's liquid. It's a lot more liquid, right? You don't have to ship it anywhere, et cetera. So why do you like the physical so much more than the paper?
Yeah, to me, it's the counterparty risk and systemic risk of the system is why I own the metal. So if you own, for example, gold in an ETF, which is very popular,
Right.
GLD or SLV, like for silver, you have to remember that metal is mostly held in London, and in London they have a lot different rule-based system than they do here in the U.S. There's a lot more transparency here in the U.S. than there is in London. So, for example, people that own GLD, the shares themselves don't even act. They're not even the legal owner of those shares. The technical legal owner of any stock held in street name at a brokerage firm is actually under the name of Seed and Company, which is an LP or a limited partnership of Depository Trust Clearing Corporation. So start with that. You're only a beneficial owner when you hold an ETF. But more importantly, when you own that ETF itself owns the gold. Now that gold is held at, for example, JP Morgan's vault in London, but it could also be JP Morgan could then sub-custodian that gold to somebody else. Maybe their vaults are filled up. Maybe it's a logistics issue. And in London, if that sub-custodian loses all that gold, the custodian has no recourse against the sub-custodian. That's a law in London.
Oh,
And the reason for that is that the sub-custodian in most instances is the Bank of England. So you can't sue the government or a bank, the central bank. They have immunity. And that's something that people need to understand when you're looking at the metals. Are you buying it for a trade or are you buying it for, that insurance policy, so to speak?
I love it. So your website is goldsilvervault.com.
Yes.
Goldsilvervault.com. So go to goldsilvervault.com. And you've got an X account where you're active. Is that what you said?
Yeah, it's a Profits Plus ID, just PROFITS ID as in Idaho.
Awesome. So thank you, Bob. Thanks for everybody for listening. Remember, when we pay attention to all the different asset classes, including precious metals as an asset class, it's that this is a huge potential for a hedge. and maybe someplace you want to put your assets that you want to be safe from, as Bob says, counterparty risk, meaning somebody else having some influence on your asset as opposed to you having it in your possession. And when you do that, when we study these things, and remember to share this, remember to like this, because when we study it, we're going to make way more money and pay way less tax. We'll see you next time on the Wealth Ability Show.
Thank you.
This podcast is a presentation of Rich Dad Media Network.